Investors who would like to be more active in their own investments should try the simplest form of investing, dollar-cost averaging. Dollar-cost averaging is the easiest and best way for the average investor to become wealthy. Passive index investing is one way to invest money, and it doesn't take much knowledge on your part. You don't need luck or clever decision-making, but you do need patience. Dollar-cost averaging reduces risk and helps maximize your long-term profits. This process couldn't be simpler, so it's an amazing tool for investors with little to no experience. Let's take a look at exactly what it means to dollar-cost average, what this method would look like for you, and how you can implement this strategy to become a multi-billionaire on autopilot. Furthermore, we will see exactly where you can invest your money to receive excellent returns for doing absolutely nothing, often returning 10% per year or higher. Our name is Financial Freedom, and we help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Dollar-cost averaging is a method that involves investing a fixed amount of money on a regular basis regardless of price fluctuations, whether weekly, monthly, or even daily. Let's assume you invest $500 per month into an ETF that has a share price of $100. Just like any investment, the value fluctuates from day to day. During the first month, your $500 investment buys 5 shares of the ETF. The next month, the ETF might be priced at $75 per share due to market volatility. This means your $500 will purchase 7.14 shares. Now, at month 3, the ETF has recovered its losses and risen to a price of $130. Therefore, your $500 investment only purchases 3.8 shares. A rising share price typically means your $500 investment will buy fewer shares, while a falling share price means you can purchase more shares with the same amount of money. This is fantastic because the decision of how many shares to buy is made for you. Over time, you may even be able to lower your average cost per share by buying during volatility. The fluctuation in price means you will not be too concerned whenever there is a substantial drop, but instead excited, as you will now have the opportunity to purchase more stocks for a cheaper price. Dollar-cost averaging is a financial strategy that can be set up in advance by investing regularly. It invests the same amount of money each month, lowering investment risk. This can be taken directly from your weekly paycheck and directed into a 401k account. Or it can be withdrawn from your bank account. The great part about automating the process of investing is that you're more likely to do it every single week, month, or whatever period you decide. If you don't use automatic contributions, it's much more likely that you'll consider not to invest. Just imagine when your paycheck hits your account every other week. Now you must ask yourself if you should invest and how much you should invest. Or, if you should skip investing this week and use that money for bills or other expenses. Skipping 1 week won't hurt, right? It sure would be nice to use that money towards a night out. In reality, 1 week won't hurt your retirement, but skipping a whole month might make it more difficult to reach your financial goals. The additional savings needed will be hard to catch up with if you keep going on like this. Automating the process and deciding when and how much you will invest ahead of time makes investing easier to do on a continuous basis with no interruptions. Besides, when the money is automatically directed towards your investment account, you're much less likely to notice it's missing from your paycheck or bank account. By investing the same amount of money regularly, there's no need to worry about buying at the wrong time. If you sink all of your money at once into an investment, there's a risk that you're investing right before a big market downturn. To put it in perspective, imagine you were investing $10,000 each month for 4 months. If you had invested all of your money in 1 month and then the market dropped 20% on that last month, your total investment would end up being less than if you had laid out your investments over a longer period. By dollar-cost averaging, you would have invested a small chunk before the market tanked, and you would have continued investing smaller chunks as things progressed, thus resulting in an average price accumulation and prevention of increased loss due to a bulk purchase. On the other hand, you might also miss out on investing at just the right time before the market begins trending upward in a bull market. Imagine you suddenly find yourself with an extra $1 million that you plan on deploying into the market but aren't sure of the best approach. Should you invest all $1 million at once or implement a strategy to invest a portion of it regularly over the next year? Investing it all right away means that you'll be in the market for a longer period of time. Whereas, investing a little bit over time will ensure you spread your eggs out instead of putting them all in one basket. A study by Northwestern Mutual found that over a 10-year period, returns on a $1 million chunk of money invested immediately in the stock market perform better over the same amount of money invested evenly over a 12-month period. The 10-year returns for the $1 million investment beat the dollar-cost averaging strategy by 75% of the time. While this is a general representation, the answer to which is best comes down to how the market is going to perform going forward. Of course, if you had a crystal ball and were certain that the market was going to go up constantly without any hiccups in the future, then you would want to invest all of your money right away. This is a risky bet that could go either way. For example, if you invest your $1 million just as the market nosedives, it's possible that you'll only see $750,000 upon selling. The best decision is usually investing everything at once because historically speaking, the longer amount of time you're invested, the better. Unfortunately, most people don't have a huge amount of money they can throw into the market. Instead, they can set aside a small amount from each paycheck and dollar cost average into the market and enjoy the benefits of that strategy. The best way an average person can build riches is by investing steadily over a long period of time. That means investing when market conditions are great and the markets are booming, and also when times are tough and stock prices may be in a slump. Due to the lack of decision making and the stress you'll encounter when dollar cost averaging, this makes it an amazing way to build wealth. Basically, anyone who's able to automate their investment contributions and forget about them can be a successful investor. By using automatic contributions, you can keep your hands securely on the wheel as you wait for the market to rise. If it drops, you won't panic and make bad decisions that lead to dire consequences. When you continue investing during market downturns, you're taking advantage of buying opportunities through all market cycles. By purchasing as the market is dropping, at the bottom and on the way back up, you'll be greatly increasing your chances for large profits. Now, where can you invest your money to receive excellent returns that will snowball your portfolio so you can become financially free? There are many options, varying from actively traded mutual funds to individual stock picking to buying cryptocurrency. But sometimes the best choices are the simplest. Buying into the S&P 500 is an amazing investment for many reasons. Firstly, S&P 500 funds are available to pretty much everyone. There are so many extremely low-cost options, meaning the fees charged for owning some of these funds are extremely low. With companies such as Vanguard or Fidelity, buying into the index means you own the 500 largest profitable companies in the United States across all market sectors, from technology to consumer staples. While exposure to sectors varies, you're still going to be diversified across all industries. Furthermore, if a company is no longer profitable, it will be dropped from the index. Simply put, you're investing in large profitable U.S. companies across all industries with little to no cost to you. From 1957 to 2021, the S&P 500 has averaged 10.5% annually, providing you the ability to earn excellent returns from this proven investment. It's no surprise that Warren Buffett recommends most people invest in this index.